Morena koutou. Bridget, I wonder if you wouldn't mind just starting the call for us.
Kia ora koutou katoa. Bridget Coates, Chair of Centre for Sustainable Finance, Toitū Tāhua, and really delighted to see you all this morning and to be part of the launch of this really important opinion on KiwiSaver investing and highlighting various issues and opportunities. First, sincere thanks to our legal partners who have been so generous with their time. Lloyd Kavanagh and Claire Brabant from Minter Ellison Rudd Watts, Tim Williams and Emma Dale from Chapman Tripp. We are entirely dependent on your goodwill and your hard work, and I think all of us need to reflect on leaning in to help with New Zealand's transition at the moment, and we're very grateful to you for picking up that opportunity and doing so. So this is turning it back over to you or Joe, is it to you to kick the seminar off? But many thanks to all, and in particular to our authors. Thank you.
Thank you, Bridget. Welcome, everyone. Welcome to friends at Minter Ellison Rudd Watts and Chapman Tripp, and also to everyone online. I just wanted to give a little bit of background. We are recording this webinar and we'll look to distribute it to a broader audience. So just by way of background, I'll take us through kind of where we've started and how we've come to the point of being able to talk about this joint legal opinion, and then we'll cover off some next steps at the end of the discussion. Renju, if you wouldn't mind just flicking through the slides for me. Next one, please. Great. So as everyone on the call will be aware, because you're all familiar with the Centre and our work is grounded in the Sustainable Finance Forum's 2030 Roadmap for Action. And this piece of work in particular was grounded in recommendation 11 of our roadmap, which was looking at and removing barriers to sustainable finance and investment, including liquidity requirements and incentives around KiwiSaver. Sam, I can see you've got your hand up there. Did you have a question?
No, apologies, Joe, that was an accident.
Oh, okay. Well, it's nice to see you. I'll consider it a wave. Next slide, Renshu. So in the middle of last year, we convened to explore this roadmap recommendation in a little bit more detail. We convened the Investing in Private Assets Technical Working Group, of which many of you on this call were a part. The names there are on the screen. Suffice to say, the working group was a set of representatives from KiwiSaver providers and other institutional investors, and the secretariat support was provided by our partners at PwC, Feng Hu and Andrew Jameson. And the purpose of the group was really to dig in a little bit to the roadmap recommendation and think about whether there were actually any impediments or blocks to KiwiSaver investment into sustainable assets, and actually what we ended up focusing on was private assets. Go ahead, Renshu, next slide. The working group came up with a recommendations paper, and the paper is available on the Centre's website. Renshu will also pop it in the chat. The paper outlined essentially 4 key barriers to KiwiSaver providers investing in private assets. So a lack of clarity, regulatory and policy clarity in the current KiwiSaver scheme, KiwiSaver managers needing to improve capacity and capability required to do active fund management, that some organisational and market challenges that are posed by private asset investment, and also among KiwiSaver members a relatively low literacy and sort of understanding of the benefits potentially of this type of investment for themselves. And then we also identified additional steps that could be taken by government and regulators to remove barriers. Go ahead, Renshu, next slide. So that brings us to today and the joint legal opinion. So the Centre instructed both Minter Ellison, Rudd Watts and Chapman Tripp to produce a legal opinion, and they graciously stepped up to the challenge and have invested considerably over the last few months in developing that opinion, which we are about to release to the media over the next couple of weeks. And so the purpose of this call is to give you all an opportunity to really dive into the opinion, to ask questions of the team who prepared the opinion, to get an overview, or I guess an advanced preview of the Centre's positioning in the public domain on this, and to ask any questions or raise any comments that you have about the work that we'll be undertaking in communications over the next couple of weeks. In terms of next steps, we are also having a similar webinar as this for representatives of the government, and that will happen next week, and we will look to sort of, I guess, promote the opinion and the recommendations of the working group further once we have undertaken our engagement with the media. Just before Christmas, an important thing to note is that the recommendations paper and the legal opinion was sent into various ministers, and we have had some positive signals from Minister Bailey, who's the Minister for Commerce and Consumer Affairs, that he's open to a review of KiwiSaver settings later in the year. And so we do expect that we'll be able to support a constructive and pragmatic dialogue about what we might need to do to remove any disincentives or impediments to investing in private assets. And then, you know, as an extension of that, the Centre, as you know, is also focused on sustainable private assets, but that's probably a second stage for now. So I'll turn over to our friends at Minters and Chapman Tripp and invite Lloyd to just provide a few framing comments before we get into the details of the opinion.
Atamarie, and thank you very much, Joe and Bridget, for your kind words of introduction. It's fantastic to be here, and I know I speak on behalf of all of the lawyers involved that we're very appreciative of having the opportunity to contribute to this important work. There's a few contextual comments. For me, the work of the Centre for Sustainable Finance is really vital and important, and the questions that the working group were raising are really important, which includes, if New Zealand is going to have a more sustainable economy, where's the capital from that going to come from? Now, of course, some of the capital will come from government sources, but I think it's increasingly clear that a large part needs to come from the private sector as well. And for me, a particular passion is how New Zealand responds to the challenges of climate change, and that particularly involves capital as well, whether it's expenditure to assist mitigation. Think, for example, building wind farms or solar farms generating sustainable electricity, through to adaptation, building better roads, better coastal infrastructure, which can withstand the changes that are coming. And in that regard, what really sticks in my mind is, unfortunately, it now seems pretty clear that we're either already at 1.5 degrees of change since pre-industrial times, or just about there. So both of those are important. As Joe called out, the Centre's working group, from a fund manager and banking perspective, did a lot of work which had kind of provided a background to what we're doing. And we also did some research ourselves. Just to give a little bit of context, in Australia, the Australian Financial Security Authority says that of the total superannuation assets in funds with more than 6 members, 4.9% are invested in private equity, and another 16% in private property and infrastructure. The New Zealand Superannuation Fund invests about 4% of its portfolio in private investments, but then sadly the Reserve Bank data tells us that only 0.18% of the $100 billion in New Zealand KiwiSaver funds are invested in those shares. And I came across a quote from a fund manager, and this is only one view, of course, recently from John Berry at Pathfinder. And the quote is, "There's a reason high net worth investors in large, long-term, sophisticated endowment funds invest in private assets. Over the long term, they pay higher returns than listed markets if managed and diversified properly." So that was the context in which the centre came to both firms, and thank you very much again for giving us the accolade of choosing, we like to think, and I guess the Chamber's directory substantiates, the two leading firms in financial services in New Zealand. The question, are there legal reasons why this is the case? And essentially what our research found was there's no legal impediment from KiwiSavers investing in private assets. And again, we refer to private assets because that's mostly where infrastructure sits. But there seem to be a whole series of legal nudges, I'll call them, that kind of tilt people in the wrong direction from the perspective of the objectives I've talked about. So in favour of traded investments and away from private investments. That's not to say everyone does it, and there are some managers who have a higher proportion. But nevertheless, what we found in essence was there are requirements for liquidity, including the 10 working days transfer right, which are interpreted as a reason for maintaining very liquid investments. Requirements for daily pricing, and in particular a requirement that fees not be unreasonable, which in practice has been interpreted by many as being that their fees will be measured against benchmarks essentially based on traded index funds. So all of those are things that kind of nudge us in a direction that means New Zealand's KiwiSaver funds overwhelmingly are deployed in tradable investments and often tradable investments offshore. So they seem to skew towards a more conservative approach. To be clear, we're not saying the legal issues or nudges are definitive in themselves, but they're certainly unhelpful. There are all the other things that were called out in the technical working group's paper as well. But what we're trying to do with this opinion is identify some things that can be done to avoid missing both an opportunity for the KiwiSaver members and also for those New Zealand businesses looking to employ capital and long-term investments which are particularly useful for building New Zealand's sustainable infrastructure. So that's sort of the essence of what we're going to get into. Next, I'm going to ask Claire, who works in the team with me, to talk about some of the detail of the findings. Then Emma's going to talk about some of the recommendations. My good friend Tim Williams is going to talk about the future. What are the next steps and where do we go from here? Claire.
Thanks, Lloyd. So I'm going to focus on the points that Lloyd has raised as the disincentives. As Lloyd mentioned, we did not consider that there were any outright legal prohibitions to prevent KiwiSaver providers from investing in private assets, and in fact there are already providers in market who invest in private assets, Pathfinder being one, Booster, Milford. There are a number. However, the overwhelming majority of funds under management, to Lloyd's point, are not invested in private assets. And that's really because there are features of KiwiSaver's legal and regulatory environment which effectively discourage the investment in private assets. And we had isolated that down to effectively 3 key points, which were also identified in the working group paper. The first being the need for liquidity to meet account portability obligations and the switch requests. This is effectively the Section 56 requirement to liquidate and transfer a member account to another scheme if there's a request to transfer within 10 working days of receiving that notice. There's also a need for liquidity to meet member entitlements to permitted early withdrawals. These are ones that all providers are familiar with, mostly being retirement and first-time purchase withdrawals. I think it's important to note, and we have drawn this out in the opinion, that these entitlements cannot be waived, including by member consent. They are effectively hard-coded into the scheme rules at Schedule 1. So that is another disincentive. The requirement that fees not be unreasonable, including by reference to the FMA's value for money guidance, which effectively has meant that the industry has a perception that low fee products are the preference ahead of more complex and therefore more costly investment options. And then lastly, although relevantly, but probably less so on our list, is the need for daily pricing of assets. And this is effectively to, this dovetails in with the liquidity requirements, daily pricing, meaning that it can be more easily satisfied if assets are priced daily. One other thing that we did make mention of is that KiwiSaver providers have a fundamental requirement to act, effectively a statutory requirement to act in the best interest of investors and within any limits imposed by the relevant SIPO. And so then any features of a regulatory regime which prevent or discourage providers from investing in assets that could be in the best interests of investors should be considered by the government as ripe for reform. So that was another point that we wanted to highlight. One of the other points, which is not on the slide, but we thought was quite important to note, it is in the opinion which we know will be made available to you. It's worth also mentioning the main and additional purposes of the actual FMCA when considering the observations of the Centre and the working group in the recommendations that have been made. So the relative lack of investment in private assets means that consumers are not participating in the growth in private markets in New Zealand. And this is limiting investor sector choice. And so one of the main purposes of the FMCA is to promote the confident and informed participation of businesses, consumers and investors, as well as promoting innovation and flexibility in financial markets. So modifying the law to remove disincentives to providers investing in private assets when it is in the members' best interests to make that investment is actually squarely, in our view, consistent with those purposes. So that kind of gives a rundown of some of the stuff that I think that everyone on this call is quite familiar with. And we've highlighted in reasonable detail some of the disincentives in the opinion itself. And in particular, note things like default providers, not to the best of our knowledge and belief, no default providers are investing any of their default funds in private assets, whether that is in fact a missed opportunity in terms of providing for the better well-being for KiwiSaver members more generally. And so I think it's probably now worthwhile, since we are so familiar with the disincentives themselves, probably handing over to Emma to talk through the observations we made about recommendations as to how this could change.
Thanks, Claire. So yes, now that Claire's given us a good rundown of the disincentives, we looked at ways in which we could mitigate those disincentives to make it easier and I guess, more palatable for KiwiSaver providers to invest in private assets. So the first disincentive that Claire talked about was liquidity. So there are a couple of ways which we thought that this disincentive could be mitigated, which was one way was to amend the KiwiSaver rules to get rid of the requirement for schemes to electively to opt out of applying the early withdrawal rules and the transfer rules. So that would clearly remove a barrier to being able to have that liquidity available, which is not present when you're investing in private assets. Another, I guess, a gloss on this would be to allow special purpose funds to be set up, which would also be able to, the rules around those funds would not require compliance with the early withdrawal rules or the transfer rules. So members would be given a clear guidance and disclosures in the PDS for those investments, and they would clearly know that investing in that fund would be subject to certain restrictions and limited ability to get money out, certainly on notice or other rules, to allow those more longer term investments to be made without having the liquidity rules, the early withdrawal rules, cutting across that requirement. Another thought that we had was the FMA is currently considering submissions on the liquidity management policies at the moment, and there's a clear, I guess, a tension and a conflict between KiwiSaver managers' duty to comply with the KiwiSaver scheme rules requiring these early lock-ins, early withdrawal requirements and the transfer requirements, and also the ability for scheme providers to allow side pocketing of assets or other liquidity management tools. There's a very much a conflict between those things. So it would be good if the FMA was able to, in considering those submissions, to be able to perhaps take that conflict into account and provide some guidance in relation to how KiwiSaver providers could manage that conflict. All of these options and possible recommendations that we've come up with, I should note, are not mutually exclusive. They can be offered, or they should be offered and considered in combination with one another. So the other disincentive that Claire came up with was daily pricing, and we thought of some ways in which this could be mitigated, and obviously one clear option would be to for providers of these, including the government that provides private assets, would be to have a market in which the assets can be traded, and that would obviously make a daily pricing mechanism. Also, just or having a way in which a market value could be struck for those assets on a daily basis to allow daily unit pricing. Another method that we came up with was a lot of trust deeds for KiwiSaver schemes may not have flexibility in them to allow different pricing mechanisms. They might require daily unit pricing, which is difficult in the case of these assets. So to the extent that a scheme wants to invest in private assets and has a daily unit pricing requirement, then there might be a need to amend the trust deed for that scheme. So we thought that it would be good to have more streamlined provisions in the FMCA, allowing supervisors to agree to deed amendments that, maybe at the margins in members' best interests, or it may be difficult to try and clarify and satisfy that test. So allow, those amendments to be made in a more streamlined fashion. The other, I guess, disincentive that Claire came up with was the requirement that fees not be unreasonable in KiwiSaver schemes, which is obviously a gloss on KiwiSaver schemes that the rest of the market doesn't have to adhere to. And we think that there should be greater recognition for higher fees that are charged by these private asset investments, that they're not unreasonable because of the effort that KiwiSaver managers have to go to doing due diligence to find investments in these assets, and then if they make an investment in private assets, to then monitor that. There's a greater deal of effort and resources involved in that, and therefore that should be recognised as being allowing a higher threshold for those fees before they're unreasonable. So we thought that this could be done in a number of ways. The definition of unreasonable fees in the KiwiSaver scheme rules could be clarified as to what is not unreasonable, or perhaps a safe harbour, certainly in the realm of private asset investment, but just more generally as well. That would be quite helpful. Also, there's a process in the KiwiSaver regulations in which the FMA assesses the reasonableness of fees. And at the moment, it's a bit opaque as to what the FMA can or cannot consider as comparable schemes for that purpose. What fees do they assess reasonableness and unreasonableness against? So that could be also clarified as to what the comparative measure is. And also, as Claire mentioned, in relation to the value for money guidance that's out there, there is an argument that the higher fees charged by these assets, cannot be passed on to members because that doesn't represent, a good value for money. However, it should be clarified as, an update to that guidance that, value for money can take into account the exertion that the member's gone to invest in those assets, etc. And I think that would be a welcome clarification. And finally, just picking up Claire's point on default funds and the, pretty much nil investment of default funds in these private assets. We think that a recommendation could be for the MB to clarify in the default KiwiSaver provider agreements that those default providers that wish to invest in these types of assets in their default funds could propose fee increases, and then that would then MB would consider those proposed fee increases in good faith and look at them on a case-by-case basis to allow that to occur. But I guess it's unsurprising, given the fee settings for default providers, that none of them are invested in private assets at the moment. So those were the recommendations that we came up with. A combination of those we think could help to mitigate some of the disincentives that currently exist in the market, and we think should be considered by government and FMA and other agencies involved. And I'll hand over to Tim for final remarks and next steps.
Thank you, Emma, and thank you, Joe and Bridget, for the opportunity to be involved. I know we've enjoyed thinking through the legal issues associated with the challenge that's been placed to us by them and the technical working group of analysing where the legal impediments or disincentives arise. And a lot of this is all around alignment. One change won't necessarily be or lead to the results we're looking for, but it's a case of having all of the contributing factors that influence the outcomes that we're looking for being aligned towards that single goal. And as Lloyd has put so well, and the technical working group raised also, it is well known that it's desirable for New Zealand to have access to capital for investments and sustainable investments. The need for infrastructure is just well known and well articulated in newspapers. So we discussed that at length and are strongly behind the steps and reforms that Emma summarised. But that can't be the sole justification. The sole justification has to start with the fact that this is KiwiSaver investors' money to start with. And they rightly will expect, as the duties require, that the money be invested in their best interests. And it's probably not our job to assess what those are, but what we can say as a group is that there are opportunities out there that are being discouraged by the regulatory settings. Those regulatory settings were put in place for good reason. KiwiSaver was in its infancy. It had to be simple. But now with the development of the KiwiSaver market, the $1 billion worth of assets under management, $100 billion of assets under management, the significant investments that are there now, it's no longer suitable to have those settings in our view, and a lot can be done to improve the outcome for investors, as well as getting a better alignment with the incentives and the desirable outcomes for New Zealand as a whole. So there's no criticism of what's been done today. The managers to date have been within the regulatory settings that they've got, have worked in accordance with the alignment and in alignment with the regulatory regime, and we've identified as clear what the various opportunities or the various issues that could be rectified, and Emma's summarised our solutions. So as to next steps, we'd very much like to see that the government listens to the changes we are proposing, and we understand there's a session coming up shortly to engage with the government. Of course, we've got this wonderful opportunity now where the government is talking about freeing up the KiwiSaver regime already to allow for investors to invest in more than one scheme, and that will have an opportunity for more boutique schemes to perhaps set up, and that some of those may well be in the infrastructure and sustainable asset sector. But there needs to be these reforms, and as Emma rightly said, the recognition that the liquidity requirements are a disincentive to investing into sustainable assets is something that can be addressed, and we're very much in favour of that. So thank you for listening to the quick summary we've all put together. It's been a pleasure working within the team and having a chance to make the contributions to the improvement of outcomes, not only for New Zealand but also for KiwiSaver investors. And it's a passion we all share, I think, in this room. So thank you for that, and I guess we open up for comments and questions from the room.
Well, see, Tim.
Thank you, team. We do have a question online from Justine in the chat. Justine and anyone else, I might invite you just to turn your camera on and go ahead and ask your questions. And since it's a small group, we can use our emoji hands to keep asking questions rather than typing them in the chat. So go ahead, Justine. Or I can read the question out from the chat, which is, and I'll open it up to the group, whoever would like to answer the question. Can you please elaborate on the rationale for conclusion that managers cannot override or opt out of the statutory redemption entitlements currently? It appears that some managers are already making such provision in their scheme documents. And then Justine had a follow-up question, which was, for those managers already investing in private assets, how have they been able to navigate the identified challenges?
Why don't you take the first one, Tim?
Oh, well, sorry, I was going to volunteer Claire for the first bit.
Yeah.
Oh, I think it's a really good question. The primacy of the statute is really what we're talking about in our opinion, and there isn't the ability to override the positive obligation on the manager to meet the members' entitlements to withdraw under the scheme rules. So that's the very fundamental legal position. And one of the disincentives that Emma talked about, the recommendations to, was the fact that there isn't currently, and I think potentially this is what the question might be getting at, there isn't the ability at the moment under the FMA's liquidity risk management guidance to side pocket or suspend or otherwise hold over withdrawals or entitlements to withdraw under the statute as it's currently written. So one of the recommendations we have made in the opinion, which would, I think, facilitate the outcome that Justine's referring to, which some managers might already positively be doing, pursuant potentially to the FMA's guidance on this, is to make it clear that where investment in private assets is occurring, there is a facilitation to allow you to treat those assets differently. Would you like to expand on that?
Yeah, I think the legislation is very clear, particularly on the transfer obligation where there is a 10 working day requirement. If someone requests to move from one scheme to another scheme, the transfer has to be effected within 10 days. The law is paramount in this respect, and no amount of guidance can change that, I'm afraid. even if we would like it to. And so that is one of the issues, because of course if you have to have all of your assets available to meet transfers, then on the risk of a run of the scheme, then that disincentivizes long-term investment. So that's one of them. The early withdrawal, the opportunities in a fund for early withdrawal, again, an unknown for managers. It doesn't sort of mean that managers have to keep all of their assets in liquid securities, as Lloyd will explain. But the problem is that if you have your SIPO requires that you have certain limits. And the problem with that is if you've got a fluctuating fund value, then you might exceed your limits. If you say, for example, had 5% in private equity, if you go right up to that limit and then the market declines in other assets, then you exceed it. And that's considered to be, a black mark effectively for fund managers. So that makes it a bit more complicated. And so yeah, those are the sorts of things that we think could be rectified, but it starts with the law in that respect. Also, early withdrawals, again, they are mandatory under the legislation. And Lloyd, you want to talk about the opportunity to work within the scope of those constraints?
Yeah, so I'm picking up Justine's second question, which is, well, if as you say, there are disincentives, how come it is that there are some managers who are already, or KiwiSaver providers, who are already investing a higher proportion, so in some cases approximating that 4% of the super fund, or maybe even higher than that? How are they doing that? But what those guys are doing, and they're typically New Zealand owned, I guess you'd call boutique players, although some of them now are really quite large, leaning into and taking a strong position which stands a little against the stream of things like the view and the way many in the market have, in our view, misinterpreted the messages from the FMA in terms of value for money. I think a point that Emma was making very powerfully is that while there might be higher returns from private asset investments, they are higher maintenance in terms of the effort to assess them, to do due diligence. There isn't a market price that's already priced in. Then they require ongoing oversight. And of course, the people who do that work expect to be compensated for it. So you see some of the fund managers being very clear and transparent in their PDS and their disclosure documents that that's what they're doing. But they do have a sense that they're standing out against a prevailing view where, rightly or wrongly, and I think the FMA would tell us wrongly, the benchmark against which things like fees not being unreasonable as being measured tends to gravitate towards the costs that are involved in traded index funds. So as we said at the outset, many of these things are nudges, not bright line rules, but if we're going to facilitate better decisions being made, as Tim points out, in the interests of the members of schemes, particularly where they may, there are changes in the law to allow people to say, okay, for all or some of my investment, I'm not looking to transfer within the 10 days. For those to be offered, and therefore those greater returns to be achieved at the same time fitting with the objectives of funding those important projects that we've talked about. I think I'd also call out that those folk who are making those calls and making these investments are very conscious that they stand out from the market. And so that makes it all the more difficult when you are benchmarking. In the longer term, you would expect will have superior performance, but it may take some time and is not as easy to call out day to day. So we're about, in our opinion, we're essentially about removing legal nudges in an unhelpful direction to allow KiwiSaver providers to make the right calls in their members' interests and have a broader spectrum of investments that they would look at. Probably more aligned with the other markets that I referred to, in which there are many where that they're not all overwhelmingly in traded assets.
Yeah, I agree. I mean, it's very much the opportunity to expand the investment universe, to give opportunities for fund managers to take up investments they otherwise may be disincentivized to adapt to. Thank you for that question.
Yeah, just to kind of round out, and I want to be really clear, we are not suggesting that these types of investments be required or mandated. We are, as Tim says, about expanding the universe of choice so that people can make the investments that are right for them.
Thank you. David Woods, you had your hand up.
Thank you. And Lloyd and Tim and Emma and Claire, thank you very much for a very useful and informative analysis. The question I have is not really a legal question, but coming back a little to what you were talking about a minute ago, Lloyd, in member interests. Do you, in a general sense, have any impression as to how much demand there is from KiwiSaver members for broader choice, for really widening out? Because it doesn't seem to me there's the same bottom-up push as we've seen in some other countries.
I think probably you, David, and others on the call are in a better position than we as lawyers to assess that. I think probably some more sophisticated investors may understand the point. I think, though, for many, it is the development of greater levels of competition and different approaches being taken to provide a menu for those who want to make investments in private assets. It is, I acknowledge, something that we hear from clients that, you know, they have a sustainable fund and it quickly fills up, but then there's not this overwhelming sea of demand that they struggle to fill. I think that's why it's also important that you look for long-term performance, because at the end we are talking about New Zealand's retirement savings here.
Yeah, anecdotally, I think we recognise that there may be demand, but a lot of it is built up and they will come simply from the fact that you're dealing with a reasonably unsophisticated audience who are aware of what's available in front of them, but don't sit down and say, what other opportunities are there out there for the investment market. As KiwiSaver gets more of more actively advised on by financial advisors, you know, given the growth and the size of KiwiSaver investments per person, it's more likely that the demand will come from that sector than from the general public. But there will certainly be individual pockets of the public who would want this now, and sustainable investment is you know, a popular choice worldwide amongst a group of investors, not everyone obviously, but and that fluctuates. But the answer is there's got to be the opportunity for that market to be met. Lloyd put the point that we discussed in our meeting. We're not forcing on anybody to invest into sustainable investments, quite the opposite. We're trying to provide the opportunity on a level playing field for that to be achievable for those people who want it.
And I think in that regard, we're also calling out the point that I mentioned earlier about what is in our view a misinterpretation of value for money, which has been interpreted by some commentators and indeed by some providers as simply what are the lowest annual fees that you can charge, without looking at, in the medium term, what is the return that you're getting. And so that is one of the things that we think there is an opportunity to continue to build on the messages from the FMA already. Don't misinterpret their advice as being charge the lowest fees possible. It is a case of having clarity about the returns and the risks against the costs.
And to be fair to the FMA, they do actually say this point. It's
Exactly.
just it's people reading between the lines that have led to the conclusion.
It may have been the body language in certain discussions a year or two back, but I think it's now becoming a pressing issue to address and provide greater clarity as to what is being meant.
Just
Thank
to your
you.
point, David, as well, the technical working group obviously came up with the point that there's low KiwiSaver member literacy, financial literacy. And I think, you know, it's almost to Tim's point, buildeth and they will come. I guess if a provider wishes to take the opportunity to change the settings to make it possible for them to change the opportunity to market a fund to members, then the demand might well be created at that point when financial literacy increases and people realise the return risk outcomes of these funds and or investments, and then the demand will come from that point as well.
Thank you. Now sounds like a good time to hear from Barry Coates with his question. While we're waiting to hear from Barry, I might just read out a comment in the chat from David Callanan. Thanks, Joe and Bridget. A comment more than a question, reinforcing what all of the team have said. There is significant opportunity or need to engage with the relevant regulators on these topics. An appropriately broad definition and interpretation of terms like value and fair outcomes by regulators would assist market participants. However, more narrow definitions with a focus on short-term financial performance seem to take precedence in the eyes of the regulators currently. We can all lean into this discussion with regulators, especially with the FMA. Thank you, David, for that comment.
Can I just add to that? Of course, the 1st of March is when the fair outcome submissions close with the FMA. And one of the 7 categories there is value for money. So those people who are still concerned about this have an opportunity to make submissions to the FMA on this topic.
Thank you. Barry, have you sorted out your audio?
Oh, I'm sorry, Joe. Now,
You are.
the settings previously didn't allow me to unmute myself, but thanks, Renzo, for changing those. I wanted to just quickly comment on the issue of public demand. As most of you know, Mindful Money and RIA do annual surveys of the public, and I think there may be a crossover between those who are interested in sustainable and impact investing and private capital. And we've seen a huge increase in the number of people who are aware of the idea that they may be able to invest in positive benefits and are interested in exploring that, given the fact that most of those opportunities are in the realm of private assets. That may well be a latent form of public demand, which isn't always obvious and which is largely being unmet at the moment. My question to you all, and thanks for great presentation and great work, is you mentioned the nudges that are currently impeding more investment in private assets. And the fact that individual providers are still able to do some. Other things that collectively you found that the finance sector could do, given the fact that government regulation is some distance away and perhaps uncertain, other ways that the industry could address some of the issues that you've identified as being nudges that are impeding more private asset investment at present?
I think, Barry, to the extent it goes beyond the legal questions that we're being asked to address, I couldn't do better than refer you back to that working group recommendations report, Investing in Private Assets, the joint paper on recommendations to reduce barriers and challenges for KiwiSaver investing. There's so much good material in there, and hats off to the team who put that together. I really encourage everyone to read it, even though it's been out there for a good, it was May last year, so quite a while.
Yeah, no, it is impressive. I agree. I think the key way, to make investments work is obviously make them a compelling choice for investors, and whatever sector those investors are. So that's the challenge, I think, for the industry as a whole. But we are working with quite a number of people who are getting very actively involved in private asset investments, high wealth individuals and large organisations. And the simple reason that they're doing that is because the returns are there, and they can see that it's a logical place for them to put their money. And some of them are motivated by altruistic aspects, but generally, I think there are real opportunities out in the market in the sustainable investment area for people to be attracted to.
Yeah, I refer back to that quote that I called out in my intro. Over the long term, they tend to pay higher returns than listed markets if managed and diversified properly. They take more care, right, and more energy, more oversight, and they can go wrong, as any investment can. But that's the reason that we, like Tim, are seeing high net worth investors in particular leaning into this space, and KiwiSaver providers, members have not yet having those benefits.
Yeah, so if the smart money is going towards some of these investments, then really it would be nice if KiwiSaver could be part of that game. That's the sort of point of everything we've been talking about today, really.
Thank you.
Okay, so I think this brings us to the close of our question time. Thank you, team, for your presentation. And I suppose I'd just like to close by reminding everyone on the call that we will be going out and sort of doing some work to raise the profile of the opinion and the recommendations paper in the media and the public domain over coming weeks, and that will start in earnest next week. For those of you in the call who are part of the technical working group, you have been sent a copy of the draft media release, and we're finalising that today, and we'll redistribute that to everyone I think this afternoon or tomorrow morning. Our goal at the centre is to bring, New Zealand investment managers in line with leading practices globally, and to make sure our regulatory environment and supports that behaviour and is competitive. And we are really pleased to be able to open up this discussion and create and hold the space for a robust debate about what some of these pathways might be. So we really appreciate your time today. We encourage all of you to look out for this narrative in the media and weigh in, and to engage with that recommendations paper and the opinion in detail, as Lloyd said. And we look forward to talking more with you all about this in coming weeks and months. Thanks, team.
Thank you, everyone.
Thank you.